Monday, February 14th, 2022, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at why we are on unavoidable roads towards currency collapse and hyperinflation. Is that because I'm a pessimist? I'm a Cassandra? No, I think people should continue to live their lives as best as they can, try to be as happy as they can, of course. But I think it's good to be aware of what's going on, and it's going to be very disruptive. And I think we're seeing already that things are very disruptive economically, socially, politically, internationally, or geopolitically. So what I'm going to do today is look at all the symptoms of hyperinflation, all the symptoms that you need to germinate a hyperinflation or a currency collapse. And then afterwards, of course, we're going to look at the markets quickly this morning. So I've written down a lot of symptoms here. There's more than 10. And a lot of them, of course, are connected. But I think you will detect them, that they are around. And I'm going to give you some examples as well. And before I start, though, I'd like to recommend a couple of books that I've recommended many times. And many of you know these two books. But these two books gave me the wherewithal to understand hyperinflation and currency collapse. And the first one is Fiat Money, Inflation in France, Andrew Dixon White. And the other one is When Money Dies by Adam Ferguson. So I highly recommend these two books if you want to understand more about the symptoms and hyperinflation. So let's start with the first symptom I wrote down, and these are not in order of importance, of course. First one is insurmountable debt. So the other day, U.S. national debt just went through 30 trillion, which is like 130% of GDP. We know GDP, of course, is a Keynesian measure that adds government expenditures. So I would say the debt is even worse, and we have all the unfunded liabilities. And it's not just the United States, Western Europe, Japan. I mean, look at Italy. Italy has insurmountable debts, and not just governments, but the general public as well. We live in a credit-induced society. So that's the first one. The second one, loss of confidence in the political system. And this is not a loss of confidence in the party in power. It's in the whole apparatus of the state, I would say. And if you look back at these books, the same thing was happening in France, revolutionary France, of course, and in post-World War I Germany, where the German Empire collapsed, and the Kaiser had to abdicate and go into exile in the Netherlands. So that's the second one. I would also say that there's loss of confidence in major institutions like academia, like law enforcement, and like business. So we know what's going on nowadays. Business, of course, I would include banking, pharmaceuticals, academia, of course, universities, and I guess I would also include the mainstream media. So that's number three. What's number four? Well, it's to do a little bit with number one. When you have insurmountable debts, you monetize the debt. Of course, you have a central bank to help you do that. And even though we're told that the Federal Reserve or the Bank of England or the ECB, for example, that they don't buy directly from governments. And that's true, but all they do is use the private commercial banks as a link. So, and also the policy of QE, of course, to keep interest rates low. That's debt monetization. So, yeah, that's a huge part of it. Number 5 now. So debt monetization was 4. Number 5, wealth inequality. So, yes, it's worse than ever, I would say, in many countries. And that's developed countries in the Western world. We're seeing society get more and more divided. There's more and more people struggling, middle class, lower class, while the very rich are getting very rich. And I'm going to come to another symptom that's related to this. So wealth inequality. You just have to look at the data actually from the Federal Reserve, Board of Governors of the Federal Reserve. I've looked at that before, and since 1989, I think the top 1%, they're now at 70% almost of the wealth, or the top 10%. And the bottom 50%, they own less than, I would say, 4% of the wealth. So it's becoming more and more like a third world country. And this is not just for the US, for the whole of Western Europe. And I would say the US is worse, though, in terms of that. Number 6, this is related to the wealth inequality. And it's conspicuous consumption. And that is a symptom of the rich getting richer. I was watching a series on Netflix. I'm still watching it, called Inventing Anna. I think that's a really interesting look at how the people at the top 1% live, and how, yeah, the conspicuous consumption is so great, the private jets, everything really. And then you have the other side of the fence, where people are struggling to pay their food bills, their utility bills, to pay their rent. So that's number 6, the conspicuous consumption. I think we're seeing more and more of that. We're also seeing social upheaval and protests. And that's normal in a situation that we're going into the collapse of the currency, because the people at the bottom, they're fed up, and there's usually a reign of terror, so to speak. There's a government becomes a lot more authoritarian because they don't want to lose control of the public. So we're seeing this everywhere, of course. I don't have to really give too many examples. Look at the truckers in Canada. That's spreading worldwide. We've seen protests in France again. Here in the UK, we've seen a lot of protests. It's waning a little bit because they're backing down, but I don't think it's over yet. So that was number 7, social upheaval and protests. What's number 8? Well, it's a weak economy. And the Keynesians, they'll get it wrong again. They got the 70s wrong. They didn't think we could have stagflation. But hyperinflation and currency collapse usually happens in a weak economy. Yes, we are hearing that GDP in 2021 was the highest in 80 years, for example, in the UK. We're hearing that the US economy is the best ever, that the US is growing at rates that only China used to grow at. But the thing they're not telling you is that growth is all government spending, really, because we're running huge deficits. And that goes right back to the debt. So the economies are weak. And yes, and the currency is getting debased. So yeah, it's not a pretty world where you have stagnation, unemployment, a weak economy, rising cost of living, and higher prices. And the higher prices, they are a path to hyperinflation. But hyperinflation is when people also lose confidence in that currency and they don't want to hold it anymore. And that's got nothing to do with costs, even though costs push people into that mindset. And that's when people want to get rid of currency as quickly as possible. They want something tangible. So that's the weak economy. Number 9, speculation and gambling. Well, we've seen over the last few years Robin Hood. We've seen how every Joe Blogs or every John Doe, every normal person who, and by normal person, I mean people who have a job in just a run-of-the-mill job, people speculating in the stock market, people having access to ETFs that are leveraged and so on and so forth. I mean, 10, 15 years ago, these kinds of instruments were instruments used only by professionals, well, professionals on Wall Street, professional speculators. So that's becoming more and more prevalent, and that's another sign of currency collapse. And it happened both in the 1790s and in the 1920s Germany. And why does that happen? Well, because the average person finds it harder and harder to survive through honest work because it's not there anymore. The currency doesn't pay. So they try to go big. They try to speculate. Number 10, cost of living. Yeah, we touched upon that, and the weak economy. So those are related. I won't go into it. Number 11, shortages. Yes, shortages not only of commodities, but of labor, of parts. Well, and why does that happen? Well, we're being told it's because of the lockdowns and the supply chain, partly, but I think it's got to do with the fact that producers and manufacturers and exporters, transporters, losing faith and confidence, and we're seeing government get bigger and bigger, crowding out the private sector. So that's number 11. Number 12, this is a little more subjective. It's about morals. We find that when people are living in a society where the currency or the money has no value or is losing value quickly, people lose also their morals. So that happened a lot back in those days, and I think it's happening now. All the debate about the wokeism, that's a symptom of it, and I'm not going to go into it. But all the silly debate of whether someone should go into a certain kind of restroom or not, or it's all like a little bit like the fall of the Byzantium or the Eastern Roman Empire in the 15th century. There was talk of whether a saint should be masculine or feminine, and just trivial things really in the scheme of things, I would say. Number 13, well, just like there's political tension domestically, there's geopolitical tension. And we know what's going on now with the Ukraine, with NATO, with the US trying to push people around. And I think it's going to result in a loss of face for the West and NATO. I don't think there will be a kinetic war, hopefully. And so number 14, this is the last one, and then we'll go to look at where the markets are. It's the concept of catastrophe. That's what a word that was used a lot in the 20s in Germany. Things were always getting worse, and the word catastrophe became common. And I feel the last 2 years have been like that. All the troubles we've been through that governments really have put on us, things yeah, people are waiting for things to normalize, but we always seem to get more and more catastrophes, more crises. So that's how it works. And there comes a point when the general public, when there's a spark and people just don't want to have the currency anymore. So it's not supply and demand that causes that, but the psychology. And I don't know when that will happen. That's very difficult to predict, but I think all the ingredients are there. In all my adult life, I haven't seen this happen in the West. Yes, it's happened in Zimbabwe, Brazil, and other countries, but not in the West. And I think I've never seen as many symptoms as this. So let's quickly look at where the markets are this morning. It's 8:41 a.m. London time. We've got spot gold at 1856. So we're down about $3. High has been 1863, low has been 1850. So some people were speculating whether they would come on Monday and smack gold back down. They haven't really. We're just seeing a normal correction lower from a big move on Friday. So I think it's still encouraging. We're seeing spot silver though up 12 cents. 0.5%, 23.69. The high's been 23.80 and the low 23.50. To the stock markets, the Dow futures down 200 points. The Nasdaq futures down 100 or 0.2%, and S&P 500 is down 27. The FTSE 100 index is down 2% or 150 points. So that's a big move lower for the FTSE. And I'm also seeing that the banking sector in Europe is under pressure, especially some of the German banks. Commerzbank is down over 6%. Deutsche Bank is down just under 6%. To the currencies, we've got sterling down almost 0.5% actually, 135.04. We've got the euro down a third at 113.10. We've got the dollar down a quarter versus the yen, 115.18. And the dollar's unchanged versus the yuan at 636.41. Aussie dollar is down almost 0.2% at 70.92. And the dollar is up a third versus the Canadian dollar at 127.74. And to the Kiwi dollar is down 0.2% at 66.00. To the general commodities, WTI crude is down 0.25%, 91.55. High grade copper is down 0.75% at 447.52. Natural gas is actually, US nat gas is actually up almost 5% at 410. And to finish off, a look at the bond market at the US Treasury yield. The 10-year yield has dropped down. We dropped quite a bit on Friday and we're down another 2 basis points at 1.93%. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great start to the week. Take care. Bye.